Sudden silence. Well, Emily I'd like to thank Emily for that introduction. She seems to have dropped off, so maybe I'll just start. I'd like to say that it's a pleasure to be able to speak to you in these extraordinary times. Bonjour à tous, je suis heureux d'être capable de vous parler dans ces circonstances exceptionnelles. I'm really sorry not to have been able to come out to Winnipeg and talk to you in person, especially since before we started, Emily and John were saying that the weather there has been exceptionally nice. But and normally the members, you know, I and the other colleagues on the governing council of the Bank of Canada like to come out and visit Canadians in their various cities and communities so that we can share what we know, answer your questions, and then hear your perspectives on what's going on in different parts of the Canadian economy. And I certainly hope to do that again in Winnipeg before very long, and probably in other places in Canada too. But until then, we're making the most of the available technology to have those conversations. So the crisis that's presented by COVID-19 is truly global in scope, and its economic and financial impacts are unprecedented, both in their severity and in their suddenness. I'd like to take this time to discuss what's happened to the economy and the financial system, to outline how the Bank of Canada has responded, and to explain how we're providing the foundation for the recovery that will come next. Concern about the pandemic began as early as January, but it was really the shutdown in mid-March that sparked a rapid and massive policy response in Canada. The crisis here, as in many countries, has demanded the use of measures that we've never used before on all fronts: fiscal, monetary, and financial. These decisive measures have been aimed at stabilizing financial systems and helping to ensure that businesses and individuals have the means to survive in this exceptional time. So I'd like to discuss two phases of this event. The first is the shutdown itself, which is dictated in the first instance by the virus and by the strong public health response. That first phase has brought with it an immediate economic contraction as businesses were forced to shutter and people lost their jobs. But this shutdown will be temporary if appropriate measures are taken. Already we're starting to see some reopening occurring across Canada, and this will bring a recovery. But what kind of recovery we get will depend on the resources companies and families have been able to tap to cope during a period when many have no income. That takes credit, and it also takes government support. How those companies and families are able to cope will, in turn, influence whether the crisis has structural effects on the economy. Because of the suddenness of the crisis, many of our established ways of thinking about policy are inadequate, and we need to use other approaches to guide our policy decisions. So I'd like to share with you today how we are navigating this strange new world and how we are building the bridge to a recovery. Unlike many previous economic crises, the COVID-19 situation is truly global. All countries are subject to the same forces pretty much. At the same time, Canada's situation is in some ways distinct. To begin with, we had a favorable starting point, despite some vulnerabilities due to high household debt. The Canadian economy was relatively close to full employment and full capacity in January, and inflation was on target. And just to illustrate that, we had unemployment near a 30-year low right up until near a 50-year low right up until just prior to the shutdown owing to COVID-19. And at that point, we had about 3 million people losing their jobs and the unemployment rate shooting up to roughly 13%. We also had more room to respond with policy than many of our peers, with relatively low public debt and small fiscal deficits by international standards. Our policy interest rate was at 1.75% before the pandemic hit, so we had some room for conventional monetary policy easing. And we've long had a resilient financial system. But we're also an export-dependent economy, and our energy sector in particular has been hit hard. From this starting point, the shutdown that began in Canada in mid-March has, as I've said, been unlike anything we've seen before. Measures to flatten the curve have been effective at saving lives, but they have required the closure of major parts of our economy. Economists usually think of recessions in terms of a collapse in demand, but this time is quite different. As people were sent home and all but essential businesses were stopped, we found ourselves in a situation where people could neither buy nor sell certain products and services. So how deep will this contraction turn out to be? This will depend mostly on how stringent the restrictions are and on how long they last. Statistics Canada estimated a contraction of around 2.5% in the first quarter of 2020. For the second quarter, when we expect to feel the full brunt of the impact, we expect Canada's GDP to plunge from anywhere between 15 to 30% from its level in late 2019. So the bigger question, though, is what happens when restrictions are lifted? In our April monetary policy report, we laid out a range of plausible paths for the recovery, illustrating the high degree of uncertainty that households, businesses, and of course policymakers are currently facing. So here we show well, the dark line that leads up to the shaded area is showing how our GDP growth has, how our GDP has evolved in the previous years. You see the drop in 2008-9 in the shaded area on the left, but then the drop associated with COVID-19 is much more severe. But the banded area that's on the right-hand side of the chart is showing that there's a wide range of possible outcomes with regard to how the recovery takes place. In a perfect world, everyone would just get back to working, living, spending, and traveling in Canada and globally, and the economy would carry on as before. In fact, we'd even get an extra boost from pent-up demand. There are some elements of truth to this prediction. Certainly, we expect that as auto showrooms open, car sales could bounce back, fueled by a rebound in household incomes and low borrowing costs. We could also see a similar rebound in home sales, home resales, and home construction as transactions and projects that were put on hold restart. Now, how close we get to this kind of best-case scenario for the economy as a whole depends on many factors, and there are certainly many risks involved. There's a risk that the domestic and global economy recovery could occur in fits and starts, in line with the ebb and flow of the virus itself. Repeated loosening and tightening of containment measures in the month to come is also a risk. It's also unclear how long it will take for jobs to return even after the containment measures have been lifted. Many people have lost their jobs in the shutdown, and this is deeply concerning. There are some reasons for optimism, though. Layoffs are concentrated in the services sector, where during normal times, labor mobility is high, and that's usually indicative of lower costs of hiring workers. This third chart shows that the industries that were most affected by the pandemic shutdown are ones that have higher turnover in general. And at the top, we see accommodation and food, which for obvious reasons has been very hard hit by this whole episode. And that's seen the most dramatic impact from the shutdown. Now, once businesses reopen, hiring for some of those jobs may be relatively fast if it's not hampered by high search costs and skills mismatches. The temporary nature of the layoffs, coupled with supportive government programs, should also make it easier for workers to find new jobs or to return to the jobs they had. However, Canada's dependence on exports complicates the recovery. Many Canadian exporters are tied into complex global supply chains. When a factory in Canada is ready to resume production, but there are still shutdowns in other parts of the world, there's a risk that customers may not be yet be ready to take delivery. Similarly, the factory may not be able to source parts that it needs from other regions of the world. Indeed, this is what we saw during the initial phase of the outbreak, as factories around the world struggled to source components from China. Just as the effects of the pandemic have been highly asymmetric, the recovery process is expected to vary significantly across sectors and regions of the world economy. Some industries may quickly resume their growth, while others could struggle for longer. Now, here in this fourth chart, our staff have given their assessment of various sectors and their expected recovery times. And so, for example, the large bubble on the left denotes the retail and wholesale sector, and that was affected very strongly, but its recovery is expected to be very quick. In contrast, the air and passenger travel, which is the smaller gray bubble that's on the right-hand side, top right-hand side of the chart, was also hard hit, perhaps even harder, and will likely take a longer time to recover. So how an industry fares will depend on how it's positioned in this kind of environment, but also depends on the business's ability to source labor and capital, and on business confidence that demand will return. The best positioned firms are those that were least affected by containment measures, obviously, or the ones that could offer services remotely. Industries deemed essential, as well as those that offer substitute products, saw high demand during the containment period. These include some healthcare services and social assistance, grocery stores, food manufacturers, and deliveries. In contrast, industries relying on face-to-face contact with the public have certainly been hit very hard. Air transport, cruises, hotels and accommodations, and restaurants, for example, are all suffering. For different reasons, as I mentioned earlier, the energy sector in Canada faces particular challenges. The collapse in demand for raw materials globally had begun even before the crisis hit Canada, as the crisis took hold in China, which is the world's largest commodity importer. Most commodity prices fell, but the oil market was the most severely affected. While supply was relatively inflexible, demand collapsed and prices fell sharply. This was exacerbated by a price war that broke out involving Russia and Saudi Arabia. Even with a truce in that conflict, the drop in demand has meant storage capacity globally is nearly exhausted. For a few hours in April, one major benchmark of global oil prices turned deeply negative, making headlines, indicating that the people had to be paid to take delivery of oil during that period. These are only the latest troubles for a Canadian oil and gas industry that was already undermined by the drop in prices that occurred 6 years ago and by ongoing transport bottlenecks. The economic impact for Canada as a whole is mitigated by the fact that our industry makes up a smaller share of our economy now than at its peak in 2014. But the pain is being deeply felt in Western Canada. These and other sectoral adjustments are likely to result in damage to Canada's productive capacity that may turn out to be profound and long-lasting. Some firms may not be able to survive long with negative cash flow. Households may not be able to cope with many weeks of lost income. A lot of wealth has also been lost, due in part to the steep decline in stock markets. Both business and consumer confidence may also remain depressed, partly reflecting uncertainty related to a second wave of outbreaks. Individuals may remain reluctant to fully emerge, both physically and economically, when the containment measures are lifted. The pandemic could also result in structural changes in the economy. Even if the economy as a whole bounces back quickly when the shutdown is eased, some sectors may be permanently affected, as I've been talking about a little earlier. For example, the pandemic could have a lasting effect on travel of all kinds and undermine long-term prospects for oil demand and prices. However, there may also be positive developments in some sectors. The COVID-19 crisis could accelerate investments in e-commerce and in technologies that facilitate remote working. These changes could help some small businesses survive during the pandemic and change the retail landscape and the type of firms that are created after the pandemic ends. The pandemic could also have a long-lasting impact on global trade. Companies may rethink the vulnerability of cross-border supply chains. Protectionist policies in some countries may accelerate this reconfiguration. Based on consultations conducted by Bank of Canada staff, some firms expect business opportunities created through a return to domestic manufacturing to persist once the effects of the COVID-19 shock have dissipated. They expect supply chains to shrink and diversify, and essential health products to be produced domestically. Supply chain disruptions imply a loss of access to some markets, and consumers would likely pay more for goods and services. The experience of East Asia, where the virus first hit, provides some signs of resilience in the complex web of global supply chains. In China, the epicenter of the pandemic, strict containment measures were put in place in January and started to be lifted at the end of February. Several industries are now almost back to producing at pre-containment levels. After dropping off sharply when many manufacturers were shut down, Canada's exports to some of its East Asian neighbors have by now bounced back. But these are early days, and risks of further outbreaks of the virus remain. Moreover, near-term prospects for East Asia are dependent on the rest of the world, where much activity has yet to resume. Policymakers around the world have responded to the extraordinary challenges created by this crisis. In Canada, policy action has been taken on a number of fronts. Fiscal policy has been a central part of the early effort to contain the impact of the shutdown. Several measures, such as tax payment deferrals, are aimed at giving households and businesses some breathing room. These measures play a crucial role in limiting the number of bankruptcies and the knock-on effects that could arise with multiple foreclosures. This is particularly important in the current context of high household indebtedness, which could amplify the impact of the shock. At the Bank of Canada, we know that a continued flow of credit is essential to build the bridge between the shutdown and the resumption of growth. If Canadians cannot pay their bills and businesses cannot service their debts, the recovery will be weak. That is why the availability of credit has been a central focus of the bank's policies throughout this crisis. Let me now elaborate on the actions we've been taking so that households and firms can access the credit they need to get them through a period of lost income. Credit provision depends on the functioning of the set of markets that financial institutions rely on to fund their operations. When these markets operate normally, participants can buy or sell assets quickly at predictable prices, and those institutions that are borrowing have reliable access to financing on reasonable terms. This, in turn, allows monetary policy to be transmitted effectively to the economy. The functioning of these core funding markets was threatened by the intense financial stress that took hold in March. The sudden collapse in prices of stocks and other risky assets triggered the typical features of a financial panic. We saw a spike in volatility driven by uncertainty and a rapid fall across many asset prices. This drove a flight to safety and cash hoarding as financial institutions were reluctant to lend to one another and withdrew from market making. If these forces had been left unchecked, Canadian businesses and households could have faced a severe credit crunch. Swift and aggressive policy was therefore needed to restore market functioning. Starting in mid-March, the bank expanded its funding to financial institutions and launched various asset purchase programs, all to address problems with market functioning. Our asset purchases serve a dual purpose. First, the purchases themselves help support the functioning of the markets in which we are buying. Second, we carry out these purchases by expanding financial institutions' deposits at the Bank of Canada, which helps satisfy the demand for additional liquidity under turbulent conditions. As a result of these operations, our balance sheet has already expanded by about $300 billion, more than tripling its size from the end of January. Details of these programs and how they work are presented in our latest financial system review, published last week. 2 months on, markets are functioning noticeably better. Canadian companies have been able to increase their borrowing substantially, which is appropriate given their need to ride out their loss of revenues during the shutdown. In response, we have temporarily stepped up our purchases of federal government debt and launched new facilities for purchasing provincial and corporate debt. This is so that these markets continue to function and borrowers can continue to access the credit they need to get through this difficult period. This brings me to the direction of monetary policy. For over 25 years now, the Bank of Canada's monetary policy has been guided by our 2% inflation target. This period has included some turbulent times, and inflation has nonetheless averaged close to that target. Inflation was near 2% before the global shutdown started, and the economy was then operating close to potential. The inflation target remains our objective, and in the period ahead, we will continue to manage the risk that inflation could persistently diverge from the target in either direction. Typically, that means lowering our policy interest rate to stimulate demand when economic slack is putting downward pressure on inflation and raising that rate when we see demand emerging. But the shutdown is not typical. The most recent data indicate that inflation has declined sharply. In fact, as of this morning, it came in as 0% year on year. But that is due less to overall economic slack than to some specific factors, especially the drop in prices of gasoline and travel services, as well as shifts in spending. These shifts mean that the standard consumer price index, based on the cost of a fixed basket of goods, has become less meaningful. While many of these changes will reverse when businesses reopen, we expect to see some persistent price effects, which will differ across products and services. We will also see some further changes in consumption patterns. These will affect the true underlying price pressures throughout the crisis and the recovery period. During that adjustment, official inflation measures might also be less informative than usual about capacity pressures. At the bank, we are working to assess the impact that these shifts in spending patterns can have on measured inflation. During the shutdown, consumers have cut their spending on goods such as food away from home, airfare, clothing and gasoline, and on services such as haircuts. And on that last one, I guess I'm Exhibit A. On the flip side, the share of food purchased in stores and pharmaceutical products has risen sharply. Overall, the results indicate that the decline in inflation experienced by consumers may be less than indicated by the official CPI measure. Moreover, stimulating demand cannot do much to influence inflation as long as the stores, and indeed much of the economy, remain closed. In this setting, monetary policy needs to be even more forward-looking than usual, seeing beyond the shutdown to its potential implications for the subsequent recovery. The loss of household wealth, coupled with self-reinforcing weakness in business and consumer confidence, could continue to weigh on aggregate demand after the restrictions are lifted. Some businesses will fail, and some workers will not regain their old jobs. Supply chains, both in Canada and globally, may be disrupted for some time. While the steps we have taken should help, we are likely to emerge from the shutdown with both supply and demand weaker than before. The scarring associated with the shutdown could lower productivity, which tends to result in higher inflation. But the bank's analysis suggests that the decline in demand, stemming in part from weaker business and consumer confidence and the loss in wealth, is likely to have a larger effect. On balance, in our view, there is likely to be downward pressure on inflation. As restrictions are lifted, monetary policy will continue to manage the risk that inflation could deviate persistently from its target in either direction. Based on our assessment that downward pressure on inflation is more likely, we have already cut our policy interest rate by 1.5 percentage points to its effective lower bound of 0.25%. We are also continuing with market operations aimed at transmitting the policy rate effectively to the real economy. We can adjust these operations as needed to head off a move of inflation in either direction from the target. Just as I began with a description of these extraordinary times, I must conclude with the same sentiment. This is an unparalleled time in history, and it is hard to gauge the right action. But we knew from the outset that paralysis was not an option. Now is not the time for precision, but for decision. Les moments que nous vivons sont sans précédent et il est difficile de savoir quelles sont les meilleures mesures à mettre en place. Or, nous savions dès le début que l'inaction n'était pas une option. Ce n'est pas le temps de peaufiner, c'est le temps de prendre des décisions. To be sure, fiscal policy must do a lot of the heavy lifting, and the Canadian government and the provincial governments have taken decisive steps. That's appropriate. Elected representatives are the ones to make those decisions. Fiscal measures can target sectors and groups that are most affected by the crisis. At the same time, monetary policy works in an independent and complementary way by influencing financing conditions for the whole economy and generally tries to be neutral in its impact. As such, the Bank of Canada will do its part to help Canadians get through this period and build the foundation needed to steer the economy back on track. Thank you. And with that, I look forward to your questions.
A huge thank you to Deputy Governor Lane for speaking with us today from Ottawa, and to all those attending the webinar. It has been an honor for CFA Society Winnipeg and our co-host, the Manitoba Association for Business Economics, to have you speaking with our members and guests today. CFA Society Winnipeg is pleased to join other CFA societies from around the world to recognize May
So there seems to be a bit of a technical difficulty. I think we'll just wait until Emily returns. Or John, maybe you can get started with the questions.
Sure. I'd be happy to start with questions. Thank you again, Deputy Governor. It's been a very interesting speech today. For those of you that don't know me, I'm John Harper, President of Manitoba Association of Business Economists. We're a group of economists primarily in Winnipeg, and we host events and topics that are related to economics around here. So I'll jump into the questions. The first question that we've received from the audience today: what is the odds that Canada would go to negative rates if the US did so as well?
Well, negative rates, of course, have been very much in public discussion lately. We've made the decision to cut the rate, our policy rate, to 0.25%, and we have decided that that is a rate we view as the effective lower bound, meaning that that we don't think that a further reduction of rates would be advisable, mostly because, as I stressed in the speech, this is particularly a time where we need a well-functioning financial system, and the research and experience of other countries suggests that cutting rates below sort of a small positive level, such as we have now, can actually impair the functioning of some of the key funding markets on which financial institutions rely in order to be able to continue lending to Canadian businesses and households. So, I mean, we'll never say never, but but at this point, although negative rates are certainly an option that could be used, our decision is not to go there. And we think that the stimulus we've already provided by cutting rates to this point, and then our further, the further benefit of other operations we can carry out that go to keep the markets functioning more effectively, is going to be very effective in getting in delivering what is needed for the Canadian economy to have a strong recovery.
Thank you. The second question we have from the audience for you today is: how will Canada's credit rating be affected by all of the borrowing required that's required to fund the various relief packages?
Well, I won't second guess the credit rating agencies, but because they'll do their job and we'll do ours. But at the same time, I'd like to stress the fact that, as I mentioned in the speech, Canada started this crisis with a very strong fiscal position. I think on an international scale, our debt levels of federal and provincial governments are, started off relatively low, and our deficits also started out at a relatively low level compared to other countries, and that's really the reflection of the hard work that was done about 25 years ago to put our fiscal house in order. And certainly, it's much better to go into the crisis like this with a strong position such as we have in Canada than many other countries are facing. But with that, of course, we have had a big increase in government borrowing. But I think the important thing to bear in mind here is that it's a temporary increase, and it's designed to keep the situation from getting worse to the point where we end up with a much more prolonged economic downturn. And certainly the benefit of being able to help the Canadian business and the Canadian household through this difficult time is much more important than the effect of the borrowing on the government's fiscal position. So, I mean, in short, I would say that's not a major concern at this time. I mean, clearly there will be a time where we have to focus on that, but at this point, the main priority is to get the economy into a good recovery once businesses are allowed to reopen.
Thanks. So the next question, it's a little bit longer, so bear with me. But it seems that reducing the asymmetry or the unbalance between employers and employees or customers and businesses will play a key role in resuming economic activity. So not only taking actions that improve COVID-19 related safety, but also signaling that safety. Is the Bank of Canada looking at researching these types of asymmetric issues at this time? And how are they going to balance those?
I'm not sure I quite understood the question, but if I interpret it, it's really about how the reopening takes place and the extent to which the customers versus for example, the employees get protected against the risk of contracting the virus. And certainly that is a very important part of if I interpreted that correctly, it's certainly a very important aspect of how the economy will respond to this. But I would have to say it's not an area that's of within the mandate of the Bank of Canada really to look at. I mean, certainly these decisions on health and safety are ones that are very they're very much they require the expertise of the health authorities and other branches of government, and certainly hasn't been a major focus of our attention.
No, fair enough. I was thinking more in terms of the economic asymmetry between business and consumers, and in terms of borrowing or being unemployed and the differences there.
Yeah, well, I guess actually that does touch on an aspect that has been talked about, which is the effect that this whole episode will have on inequality. The fact that many of those who've been most impacted have been people who are in the more vulnerable sectors, and that may contribute to a rise in inequality when this whole episode is over. I'd say it's too early to tell what the impact will be, and it's not something we're really in a position to analyze at this point. But certainly inequality is a factor that can have macroeconomic effects. It can affect the way the broader economy and financial system function, and it is something that I mean, should there be a trend in that direction, it is certainly something that our staff would be likely to take an interest in.
Thank you. I know you had some different industries in your bubble chart earlier on. Are there industries other than travel and accommodation that you expect to face structural change going forward?
Well, we mentioned, I think one of the particular industries of particular interest for Canada is the oil and gas industry. And there, I think there certainly have been a number of people who've suggested that, because of the reduced demand for travel, you may have reduced demand for petroleum as well. Of course, you do have some factors that go the other way. For example, people may be more concerned about taking public transit, and you certainly hear anecdotal evidence of people buying cars that weren't buying them before. And you may also see an increased use of plastics because of people being more concerned about protecting themselves from possible transmission. And so there are probably a number of factors that could affect the market for oil and gas. But if it were the case that the effect of travel is the largest one, then that would imply a lower trajectory of oil prices going forward, and that could result in further structural changes in the oil industry worldwide.
Fair enough. And beyond specific industries, what type of longer-term impacts do you think COVID-19 will have on the Canadian economy overall?
Well, certainly it's too early to be able to say very much. I mean, certainly as I mentioned, we've seen some evidence that businesses are starting to reconsider their supply chains. That's certainly what we've heard from some of our conversations with Canadian businesses, the sense that there may be a tendency to reshore some activities or possibly to diversify them. Instead of having suppliers in one country, you might have them in 2 or 3 different countries, so that if there were shutdowns such as we've seen, then they wouldn't lose that access to their fundamental, to their basic components of their operations. So you might have some of those activities. Certainly, this COVID-19 episode has given a boost to all sorts of teleworking arrangements. I think many of us have found that we can function very well teleworking, but we've also found that there are some challenges, and I'm sure that all kinds of businesses that will find ways of improving the whole teleworking experience will have a huge set of opportunities. And certainly Canada is very well placed to, with the kind of know-how and technological expertise to take advantage of some of those opportunities. But certainly there are a whole range of possibilities, many of which I think we haven't even had a chance to think about yet.
Fair enough. Next question. What risks are you and the bank thinking about with the balance sheet unwind that's going to come eventually?
Well, we're not really there yet. I mean, at this point, we're, of course, at some point, some portions of what we've done are already unwinding. For example, we had a program to buy commercial paper and bankers' acceptances, and those markets have been stabilizing, and so that the need for those facilities is quickly diminishing. And so those aspects really happen fairly quickly because they're short-term securities, and so they just roll off our balance sheet when they mature, and really that's compatible with markets continuing to function very well. I think the more challenging part of it will be, how we think about longer-term obligations on our balance sheet, because we have been purchasing longer-term bonds and so on, and so at this point we're doing those operations in the interest of keeping markets functioning well, and so our purchases are really being determined by our perceptions of market conditions. of course, at some point we will, once markets have normalized, we will have to think further about what will be the appropriate length of time to keep things on our balance sheet, whether we'd basically keep them until they mature or whether we would at some point be selling them back into the market. But again, it's really too early to be making those decisions at this time because we still have markets that have some way to go before they're fully back to normal.
Okay. And further to that, with 300 billion balance sheet expansion and probably devaluation of a number of currencies worldwide, what do you see as a role for crypto assets playing in the monetary system going forward?
Well, of course, we've talked at greater length about crypto assets in some other settings, but I think one thing that's been quite that's been quite interesting here is the fact that there has been an interest in greater interest in all kinds of online transactions and digital commerce, and that is something that may well endure beyond the shutdown itself. I think people may have developed a habit of buying things online, and if that turns out to be the case, of course, it'll give a boost to all kinds of digital means of payment. Of course, many of us shop online using a much more conventional digital means of payment. We just use our credit cards or debit cards online. But certainly. Certainly, various companies are coming up with other ways of paying for things online, and including the so-called stable coins, which are designed to be used for all kinds of electronic commerce. I think another thing that is also changing the landscape is the fact that during this period of shutdown and fear of transmission of the virus, we've seen diminished use of banknotes, of physical cash. And I mean, this is something that we find concerning because, of course, there are some households that rely very much on physical cash because they don't have full access to banking services. And so when merchants are not accepting those things, this is actually shutting those people out of being able to buy things that they need in some cases. And so this is something we think is concerning. And to the extent that that becomes a longer-term trend, and we actually see, if we actually see that, don't see a full rebound in the use of cash after the economy reopens, then this would be something that would move us further in the direction of trying to come up with an alternative that would actually reach all Canadians and be fully usable in a world where electronic means of payment are increasingly taking a dominant position. And I talked in February about the idea of having a central bank digital currency, which would be a form of digital means of payment that was created by the Bank of Canada and it was essentially a digital equivalent to cash. And that's something that, of course, we're continuing to think about. But this move away from acceptance of banknotes is something that, on the whole, would actually make some of those explorations a little more urgent.
Thank you. And so this is the last question for today. This is time is just about up, but on behalf of the CFA Society of Winnipeg and MABE, thank you very much. And the last question is an interesting one for Manitoba, where our premier is concerned about keeping debt down throughout the crisis. But are you concerned, in other cases or in our case as well, about provincial debt levels coming out of the downturn and coming out of the COVID recovery?
Well, as I said, all levels of government in Canada are starting from a very good position, and it is very important in these times to give the adequate support for businesses and households in Canada. to help them through this period where they're losing income and where businesses are losing revenues. And so, in that context, we're not concerned about a temporary buildup in debt, and at this point, I think the most important thing is to provide full support for the economy. And of course, I'm not commenting on any particular provincial government at this time, but basically, this is an area where we don't see the debt issue as being the most important one.
Okay, thank you very much. Those are all the questions we have for today. I hope our listeners enjoyed the speech and the presentation and the questions, and I hope everybody has a safe and great afternoon. Take care.
Yes, good afternoon, and thank you very much.